thank you all for tuning in. Real estate private equity is a very interesting subject, and I say that a bit with quotation marks because I think it's so much of a buzzword when you listen to it. I remember when I attended university over a decade ago, studying real estate, that everyone was just talking about, yes, I'm studying this degree because I'm going to go into private equity real estate. And I thought to myself, but private equity real estate, it sounds so sophisticated, so advanced, so complex. And they say you shouldn't meet your heroes, in principle, because when I actually started to realize what private equity real estate is, as opposed to just typical real estate investment, I started to realize, alongside my family, I've actually invested privately into real estate for a long time, and it was effectively private equity real estate altogether. So I think, as exciting as it is, I think there's a bit of a misconception, when people say, I work in private equity real estate, because they like to remind you of that. And there's nothing wrong with that. Don't get me wrong. It's there's definitely skill involved, but I think private equity real estate is only different from real estate investment in terms of how capital is raised and how it's distributed overall. And I think we're going to touch a bit on that. So, um, in summary, in the simplest of terms, private equity real estate is essentially just pooled capital, pooled equity capital from private investors to invest in deals or to invest in real estate deals. Now, there's a lot of key players in that process, which makes it different from, a typical just a direct investment. To give you a simple example, for example, if I want to, buy a house, let's say I have £1 million, that's my private capital, that's my private equity, and I buy the house. Simple as that. If mom and dad, who's rich, gives me 80% of that money, it's still private equity, but I've raised 80% from mom and dad. If we get a mortgage, you now have mom and dad, myself, and a bit of a lender that's combining that into actually purchasing the asset. And the more key players that you add to this transaction or this deal, the more sophisticated the distribution of the value of it, you know, effectively becomes. And that's why it's important to distinguish between your limited partners, your general partners, and your sponsors. And before we touch on to the points in here, a simple example of that would be, for example, you and me, the retail investor. We say, okay, we want private equity exposure through our investment manager. Let's call it boutique investment manager. That's the firm's name. They raise from all of their clients money, which they then give to a general partner, which would be your Blackstones or Goldman Sachs or whoever, who is experts in making real estate deals and investing privately. And let's say they buy a hotel business or they buy, a hotel chain. The sponsor would be the people that's managing the day to day of the hotels, because obviously it still needs to operate for you to get the money out of it. So, in simplest of terms, that's the logical chain of how it operates. You're starting with raising the capital from us. The GP would go and get that from the boutique asset manager who pooled the funds for them. They would get more finance, let's say mezzanine finance or a senior loan or just debt from the bank. And they would tell you, okay, this is the mandate. This is what we believe we can deliver for you. These are our fees, and that they work with the sponsors. Now, as I've highlighted in the red box here, for smaller deals, you typically have the GP who's also, the the GP is also the sponsor, but most of the time, these GPs would, depending on the asset class that they're investing in, work with a sponsor that's on the ground doing a lot of the work to make sure that that asset is operational. But in terms of limited partners, I mean, that's your typical you and me, our pension funds that's been invested, with a boutique asset manager or insurance companies, high net worth people typically invest in private equity, people that has much more money than I have, of course. And then, for example, university endowments, Cambridge, Oxbridge, they have these colleges have these endowments. And when I was still practicing in the UK, there was a massive surge towards private equity real estate, and that was prior to COVID. So we won't go into too much depth about that. But they provide most of the capital to actually purchase these assets, and their loss or their risk is just essentially limited to how much they invest. And then you get to the general partners. Now, that's your Blackstones, your BlackRock, or like I mentioned earlier, Morgan Stanley, Goldman Sachs, who actually operate a private equity fund. They essentially are responsible for managing the fund, managing the strategy. That's what you're paying them for. You're paying them for their active um, intelligence in actually obtaining and investing your money appropriately, and they make decisions based, on your behalf. And then, of course, the sponsor, as we've mentioned earlier, is the people that's actually, executing the project. So if it was a development project, you'll have the developer as a sponsor, and it can take two forms. If it's, smaller deals, or if it's in a fund structure, it's slightly different. But these are your key players. So it's not incredibly complicated to understand assets or equities raised from private clients, and then it is actually deployed towards opportunities based on the discretion of the GP who's working closely with the sponsor to make it work. Now, I think a good comparison would just compare it to REITs, real estate investment trusts. Most of these are listed online. You have some private REITs, but we won't deal with that right now. But in terms of, the management of private equity versus a public real estate company or a real estate investment trust, there's quite a few differences. A REIT has a CEO, it's listed on a stock exchange. They manage the company based on, the board of directors that they, are kind of like who they need to deliver, performance to shareholders. There's an AGM. Where private equity real estate is managed by the GP, as we've mentioned earlier, or alongside the sponsor, um, and they commit the capital to that. Where the capital is raised in private equity privately, in REITs it's publicly. You and I can access that directly via the stock market. But there's also a key difference in terms of regulatory impact. So private equity has a bit more flexibility. And what we mean by that is, REITs, they have to distribute, they have to disclose everything. Everything is 100% transparent. We'll touch on transparency a bit later as well, where there's just slightly a bit more flexibility. It doesn't mean you're free of regulatory requirements. That's not the case. That still applies, but it's not as public, which counts in your favor. In terms of liquidity, REITs are traded on a stock exchange. You're subject to market volatility, supply and demand, daily pricing, where private equity is a bit more, you've got a lockup period. So you can only get your money out between 5 and 10 years. So there's a liquidity premium. And because of your money being locked up in private equity for a specific period of time, and you have to pay, significant penalties to get your money out earlier, um, you don't have that issue with REITs, which is like T plus two, whatever the rate, or whatever it is at the moment is T plus one, T plus two, where when you sell your REIT holding, you immediately have your liquidity at hand. Now, diversification is an interesting subject. Because when you invest in a REIT, you're investing in, the underlying asset is still real estate. Now, there's a lot of research published on REITs and its contribution to multi-asset portfolios, but just to my personal experience as well, given the high payout that REITs provide, the distribution that they provide, the correlation between REITs and the income-orientated equity factor when in a multi-asset portfolio is much higher than it's actually giving you diversification benefits in terms of being a real estate asset because of its exposure to equity market volatility. So you'll usually have quite a high beta when it comes to REITs, where in private equity real estate, you have a lower correlation with public assets because of the nature of how it's structured, how the deal is structured, less public, less transparent. And it also gives the GPs the opportunity to shift and move strategies based on vintages, which we will discuss slightly a bit later. So a vintage of 2018 versus a vintage of 19, 22, 23, 24, 25 will be different in various forms based on the market environment at that point in time when the deal was structured, where REITs are pretty much subject to the market in real time. So in terms of portfolio impact, you will have more diversification having exposure to private equity as opposed to REITs if you're looking for alternate risk premia, just because of the nature of how the deals are structured and how the asset performs over time. Excuse me. In terms of leverage and vol, you know, what's great on the PE side of things they can exploit market interest rate environments much more aggressively. So there's not much of a there's obviously regulatory limitations for REITs because of, I mean, when you just because it's publicly traded, because they have to report quarterly, because of, capital stability, and just the ratings of these companies. Management is much more inclined to manage that alongside everything else in the business, where private equity are able to actually exploit, very low interest rates and gear up significantly depending on the vintage year and the market environment. So they can leverage up much more and be more flexible with their leverage over time because of the nature of how it is structured. And that obviously feeds into volatility. Of course, we've mentioned that earlier. REITs has substantial market price swings. I mean, if you recall when inflation in the UK, fairly recently just popped up and rates started to increase, cap rates got elevated, asset prices declined, and REITs really felt the pain um, because of it. Where in private equity, you've got a bit of a valuation lag. We'll touch on that a bit more in the following slides. But you don't have the same daily market pricing, and because of that, you don't have that volatile effect, which essentially feeds into the diversification benefit that we discussed a bit earlier. Growth potential I find fascinating because ultimately, if you're distributing 90% of your income constantly or distribute 90%, there's not a lot of capital that's retained to be deployed to opportunistic strategies or to play the market environment. Where in private equity, it's, quite different. You've got a lot of potential to actively seek new avenues to explore within our space or reposition the portfolio to be less, risky, where you kind of capped at a REIT to your growth potential for the risk reward trade off. And with REITs, you buy the REIT, and that's what you have exposure to. If you buy this type of REIT, they specialize in, let's say, industrial. That's your exposure, subject to market volatility as well. Where in private equity, if you have a lot of money, you can go ahead and you can say, okay, well, I want to actually have private equity exposure with 50% in data centers, 50% in office buildings, or whatever you want. If you're willing to pay for it, there's products out there. There's private equity managers that actually set up funds based on different private equity focused strategies. So they'll take 30% from their data center private equity fund, they'll take 30% of their office fund and 40% of their residential or student housing, whatever um, positioning, and they'll bundle that together and form a fund for clients if that's what they prefer. In terms of accessibility and client types, I mean, it's kind of self-explanatory. Getting access to REIT, you can go on your mobile phone now and you can buy, British Land or Landsec, whatever, on your phone. It's very simple. Um, in terms of private equity, you know, having worked in multi-asset portfolio management for a long time, you typically have 5 to 10% exposures to alternatives. And let's say you've got 5% in that in private equity, and your minimum buy-in is 10 million. You need 200 million to deploy just to get access to a private equity fund. So getting access to the fund, you need a very high initial investment for you to be able to actually access the fund, and you need to have a lot of capital to get diversified exposure depending on your risk tolerance. REITs are highly regulated, as we know. We've discussed that earlier. And I think the key difference between REITs and private equity is, in PE, you're looking for opportunities, you're looking for underappreciated assets. So there's a lot of due diligence that needs to go in, and that's essentially the premium you're paying for. That due diligence feeds into the active component of that, um, which requires a lot of work as well. And in terms of fees, you typically have your REITs, you've got your lower fees, and you've got the 2 to 20 structure in private equity where you'll have a 2%, ongoing fee, and then 20% performance carry. So everything that exceeds the target rate, let's say, in the simplest of terms, you have a target rate of 10%, you'll get your 10%, but let's say the fund did 15%, 20% of that surplus of that 5 percentage points will go to the GP and the rest will go back to you. So that's where the waterfall structure comes in, but we'll discuss that probably in the next webinar next week. Valuation, we don't need to spend too much time on this, but effectively you've got quarterly public reporting as you would with any stock that's listed on an exchange, where private equity is much less frequent. I mean, when I worked in at Goldman Sachs, we used to wait like probably 4 months before marks of the previous quarter came in. So you have a substantial valuation delay. Um, and how the market changed in that quarter. You might have Bank of England or the Fed or whatever change interest rates dramatically with 50 basis points during that period of time, but that mark would still be subject to previous rates. So it's very nuanced in that sense, but it does smooth out some of the vol that you would experience in a day-to-day market. And in terms of investment implications, REITs are more transparent, PE less so. But that's what you're paying for. You're paying for that less all access to all information to potentially obtain that active return or that premium that you would get if you didn't have that overall, and you're willing to accept valuation lag. In terms of private equity funds, just to briefly touch, I just want to be cautious of time here. Yeah, we're still reasonably okay. You've got your core throughout to your opportunistic with core plus and value add in the middle. And I think simple terms, if you have an established asset, high quality building with high quality tenants, your lawyers, your consultants, your bankers, that's like your core real estate private equity, just as an example. Core plus is you'd go to a suburban area, maybe there's shorter leases over there, so you've got slightly more risk, but there's opportunity for you to kind of like adjust the building a bit according to the market. Value add, which is to take something that's completely underperforming, revamping it, giving it a massive facelift, re-tenanting, um, getting marketing, going full on with this new development, turning it into a multi-asset or a multi-use purpose. That's where the value add comes in. And as you can tell, you've got the whole low risk to the high risk. And obviously the returns needs to account for that. And then finally, opportunistic, looking for data centers located in um, somewhere in Africa, for example, where you can buy it at a substantial discount. But there's a reason for that because of the risk, the regulations, the due diligence. And ultimately, you get to that point in time where you're willing to take that risk because the reward will be substantial because of how the deal is structured initially. And then I think we should just quickly touch on vintages, and I think we should think about this in terms of wine. So, when you have a 1980 wine, or I had a bottle of a 1930 this, or that's a wine vintage at that point in time, and that's very similar to the vintages of private equity funds, especially also in real estate, where a vintage in 2015 would be have some significantly different um, market environment when the fund was established, when the covenant was established and the mandate was put together, compared to one that is now in 2025. The market has changed, demand has changed significantly. So ultimately, the vintage is subject to the environment in which it was created, which allows you for a fair comparison between vintages, just to not compare apples with pears, for example. Now, what's also nice about vintages is you diversify across vintages. So if you have specific private equity exposure in your multi-asset portfolio, you will, commit some of that capital to each vintage every year. And that smooths out some of the volatility and even some of your exposures, depending on the mandate of the GP and the focus of the GP at that time, to just smooth out some of that volatility in the returns over time. It's almost like a pound cost averaging principles that you can apply. And then lastly, I think we need to just distinguish between, your primary real estate and then your secondaries. Um, you know, Primary is primarily you're raising new cash or your new equity for an investor, where secondaries, they're buying an existing interest in a vintage. So you might buy a vintage of 2021 now in 2026. It's at its end of its term. And the key difference there is you already know what is in that vintage. When you commit capital initially to that vintage as a primary capital contributor, you don't necessarily know exactly how it will be deployed, where in the secondary basis, you do know. And usually you get that at a bit of a discount. So in terms of the liquidity advantage, of course, when you deploy capital the first time, you've got like a 5-year lockup period, if it's a 5-year holding period. If you buy that 3 years later, your liquidity premium is obviously not as substantial because the fund has already, kind of delivered what it has done. And then it is priced based on its potential opportunity for the remaining years of that fund's operation over time. So those are the key differences in that respect.